Well, guys, welcome. It's always a pleasure to have everybody here. Today, what we're going to talk about is something that's very, very important. You know, there's some stats that are happening in the market where there's like literally like millions of Americans and even more than that coming in worldwide looking to trade stocks this year because of, coronavirus and people being at home. And of course, you got free commissions and, all that kind of fun stuff. So you got an influx of people coming into the stock market. Everybody's trading. Some of you guys have probably never traded before, and some of you guys have been trading for a long time. In general, though, in a hot market like we've had, stocks tend to drift higher, but that doesn't mean you're going to make any money. The number one job as a trader or an investor, whether you're day trading or doing longer term trades, is to manage your risk. Anybody can get hot for a period of a week or two or even months. But whether you keep that money or when a trade goes against you and you're actually, able to get out properly, that is the difference between somebody that lasts for a handful of months and gets hot and then not, and somebody that does this, day in and day out for a decade, 2 decades, 3 decades, whatever it might be. There's a long-term and short-term axis. Most great traders, well, every single one I've ever met, their main job is not to pick stocks. Picking stocks is the easiest part. We have all these, chat rooms and websites and scanners and different things that you can use. Finding the right stock to trade that's going to, do something that's a dime a dozen, and especially in a hot market, most stocks are going to go up. And if you have like, some specific metrics of things and patterns that you like to trade, then you're going to be in stocks that, could have big, big moves. But the thing that's going to separate you is how do you manage that trade? Can you get out when it goes against you? And then, of course, a bunch of psychological factors that help you manage your day and, of course, manage your risk. And that's really what we're going to talk about today is, how to keep your losses small. How do you know when to actually exit a trade? How to manage your stop losses. And then, of course, how to pick your trading niche. For most of you guys, we do these webinars every few weeks. We've had a million times bajillion over the last decade on how to actually enter stocks at the right point, right? That's really probably the easiest part of trading is getting a good entry. Finding stocks and getting a good entry is easy. Once whether you've taken my class or come to my webinars, a handful of patterns that you can do on every single moment, and you'll be up on stocks. It's what happens after that determines whether you're going to be good or not. So let's talk a little bit about the agenda today. Number one, this is a makeshift class from our actual trading boot camp. I think this is probably the most important one, or one of the 5 most important ones that we do in our 60-day class. When you have so many classes, there's a handful that really resonate, but there's a handful that they're absolutely necessary. And the risk management class is one. We're going to talk about, a little bit about risk management, how to keep losing trades very small. You're going to be in some hot trades, but what about when they go against you? How to know when to exit trades. I think that's really the sweet spot. How many of you guys ever been in a trade and you sold it for like, it goes up, you sell it for like 20 cents and then it just goes bajonkers for days and days. And you made $100, but you could have made $5,000. Right? It's a story of a trading career. How do you actually know, like, when you get out, right? Like when you get out. If I see some money, do I take it? There's an old adage that says you don't go broke taking profits, and that's probably a misnomer. You can go broke taking profits. If you take a $500 profit, but you could have made $5,000, then guess what? You'll go broke taking profits because at some point, your wins won't be big enough to cover your losses. So you can have some good trades, but if your wins aren't significantly bigger than your losses, then what happens is, long term, once you do the calculations of, fees and taxes and covering those losses, you don't really get anywhere. You actually may be down, even though you win a good amount of time. We're going to talk about how to place your stop losses. Stop losses is essentially just an order in the computer where you're telling your broker if it goes against you, you're going to get out of the trade. If you're brand new, this is probably just an easy way to kind of minimize the mental psychology of like when you're down on a trade because it's automated. Now, there's a lot of things that, you'll hear like, okay, well, if I put a stop loss in, the market makers will come and take the stop losses and things like that. And, there's probably a slight truth to some of it, not to the extent that everybody thinks, but there's a way to do it where if you're not putting it in the most obvious ways, then you'll still have ways to protect yourself. Because the reason you put a stop loss is not really to just like nick yourself out of every single trade, but it's really to prevent you from doing something catastrophic. So, I use something that's more like a oh shit stop loss versus it's very, very tight. We'll go over into all of those things. Yeah, how to minimize your risk, maximize your reward on these trades, and then we'll talk a little bit about how you actually size your trade. Whether you have a $5,000, $10,000, $15,000, or $500,000 account, there's a simple way to calculate how many shares of a stock you should be buying. And why that's really important is if you're just like, say you got like 10,000 bucks, and every single trade you do, you just put 10,000 bucks in it, you'll find that you'll have weeks or months where you do pretty good, and then it's gone. It's very, very hard to sustain for like years and years if you just all in on every trade or like even a flat, dollar amount where it's like, okay, I'm going to put $5,000 in every trade or $10,000 in every trade. It won't work. What you want to really be doing is using a risk-adjusted sizing model where when you have probabilities and your risk is small, you're able to actually go out and be properly sized in for the home run. And then when you have a little bit more risky trade that you don't feel that good about, but it's still worth taking, you're going to have less shares. That way, right, you're going in big when you know you have the right hand, and then you're laying off the table when you don't, and that's something we'll talk about. And then, of course, you'll have a little workshop special. Guys, stick around for the end. We'll have a special offer for anybody who signed up for this workshop. And by the way, if you guys are just brand new, if you're brand new, then this is probably a little bit over your head, as this is like the last phase of trading versus the first phase, but it's the most important. If anybody's just brand new and they need, they don't even know like anything about stocks and stuff, I got my guy Josh and Nick. They're on this webinar right now. Let them know. Just type in the GoToWebinar that you're brand new. Just send you kind of some beginner classes and like a little kit of that kind of stuff you need, and how to read patterns and all that stuff, and then come back and watch this class. It'll make like a million times more sense once you do that. But they'll get that too today. You don't have to pay for anything. It's just probably like maybe a 5-6 hour, primer on chart reading, different patterns and stuff like that. Why care about risk management? Why care about risk management? There's an important difference between a stock picker and a trader. Okay, it's an important difference between being a stock picker and trader. When I started trading, when I was brand new, I had like a really good knack for like momentum. I can always spot momentum. I could, I had an idea of like what are going to be hot stocks and things of that nature. Like I just could not get any consistency. Like I wasn't able to win every single day, which is like, or most days of the week. And that was frustrating. I'd have hot weeks, hot months, hot weeks, hot months. And man, it was really, really tricky. So, and Nick or Josh, if you're in there, I don't even know if you're in there, let me know. And there's an important difference between stock picker, trader. Make a considerable amount of money in trading. You only need a 50% win ratio. You could actually have a lot less. Good, good, good. So when I met when I met my mentor, Paul, I had been like struggling as a trader for like years and years. I've been struggling as a trader for years and years. And I met Paul on like a blog, and I was making some comments and stuff like that. Oh, there it is. There they are. Hold on 1 second here. I got a little technical difficulty. Ah, there it is. All right. So if you have anybody that needs a tutorial on any of this, let Nick know and he will get it going. Good, 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 good. So where I was. Little audio issue. Is audio good? Sorry about that. I was cutting in and out. So where we're going with this? Good traders. They all have a certain amount of rules that they have to process. Hey, Ajaz, how you doing? So every trader has a certain amount of rules that they have to process. Number one is they got to have good risk management. And so what I mean by that, and Paul's my superhero, he is. They got to have good risk management. So like when I was struggling as a new trader, one thing that my mentor Paul had, taught me about is it's not just enough to pick like a level that you're going to get out of a stock. So say you buy a stock at 80 and you say like, if it goes against me, I'm going to get out at 75, right? That's not enough to do risk management. Great trader, they practice not just only risk management on a particular trade, but they practice risk management in terms of their personal patterns. So that's the psychological part of trading. And what I mean by that is trading is mostly math or patterns, but there's a psychological component to it. If anybody's ever traded before, when you have money on the line, right, and you're like brand new, there's times you make decisions that you don't even want to make. Anybody ever done that? It's like you know what you're supposed to do and you don't do it. That's a psychological thing, right? That's you can have the best system in the world, but then it doesn't work. Why? Because you ad-libbed on. So a great trader has an acute understanding of their personal patterns. And what you have to really do with this, on top of like every trade that you make, so every trade you make, you should be journaling. We use this Trader Sync or Trader View. There's two of them that we use. But every trade you make, you should be journaling it. And that means like you can see where you buy and sell. But beyond that, there's a second part of it is that you should be journaling out your personal patterns. Like what were you actually feeling on these trades that you messed up on? What were you actually feeling on the trades you messed up on? That is very, very important. That is very, very important because you may have the best pattern in the world. You may do something and you can recognize it, but then the trade goes wrong because you didn't actually follow the rules. So you've got to really kind of narrow down like, okay, I knew what I was doing on this. I saw it, but then I still messed up the trade. So what was happening in that moment? Were you nervous? Did you wake up late? Did you not prepare? Was your boss breathing down your neck while you're trying to make this trade? All of those things really come into play. And by cataloging them and having an understanding of them, what's typically going to happen is now you're going to be able to go in and say, all right, these are the things that are getting me in trouble. Like for example, I had, and this will be in like about 2007. So like if you watch me trade like in our chat room and stuff like that, I'm always really, really good in the morning. Like, that first hour of the day, like, when I'm trading in front of my guys in our Discord group, like I'm always really, really good in the morning. But what typically, would happen, like this is back then when I first started Bulls on Wall Street, I always hit my morning trades. So then what happens is like if I missed out on my first morning trade, I'd get nervous because I'd have like all these people watching me and I'd be like, oh man, like now I don't got, now like, I didn't hit my first trade. So then my next trade would be a dog and then the third trade would be even worse. And then what would happen is I'd spiral out of control. Like I'd be like going bigger size, I'd be over trading, all because I lost on the first trade because I'm so used to winning on the first trade that like that one day a week where I didn't do that, it would be just like this big disaster. And I would end up giving like multiple days worth of profit. So it's a risk management, like a risk management issue. Other personal patterns, like while I was trying to figure this out, I was working and my boss is barking at me. Right? Your boss is barking at you in the morning. Man, he stress you out because I'd be like, he'd be barking at me and then I'd get on the computer and I'd be like, man, fuck this guy, right? And I'd be like, I got to get out of this job. I got to get out of this job. I hate it. And I would start trading, like try to make forced issue, right? Make some money so I don't have to have this stupid job that I liked, but you can always convince yourself you didn't like it. And I would screw up the trade. So these are like different things that are personal patterns. You need to catalog these anytime you're making a mistake. Is it a strategical mistake? Like your mistakes have to be categorized. Did I make a strategical mistake, meaning I messed up on the trade because I actually don't understand how to do that type of trade? Or did I make, right, a mental mistake? Meaning I had a full understanding of the trade and what I need to do, but I wasn't able to capitalize because I made a personal mistake where I deviated from my plan. So there's always two types of things when you're journaling. Did I make a strategical mistake or a mental mistake? And that's going to give you a guide into figuring out what you have to fix. The second part of this is proper position sizing. Like I said, like most traders I know, and I used to do this all the time, like I just put $10,000 in every trade. Whether it was a good trade, bad trade, this was 13 years ago. I put $10,000 in every single trade. Like it's just a flat thing. Or I would buy 1,000 shares of everything. I had like two things. If it was cheap, I would buy 1,000 shares of it. If it was more expensive, I put $10,000 in it. And it was just a fixed sizing. But why that's wrong is that if I have a trade that's like a junker, I have the same number of shares as I would if I had a trade that was actually hot, that actually was worth something. As with any type of business or any type of trading, when you have a heater, you want to be in bigger than you would if you have something that you don't feel that good about. So just different things to think about. Picking high probability, low risk trades. So when you think about high probability, low risk trades, how do you pick a high probability trade? So think back on like the last like 5 webinars we've been doing. We've been doing them every single month. How do you pick a high probability trade? So this is an addendum to last, 2 weeks ago's webinar and the week before that's webinar. If you haven't seen those, I'll make sure to get those to you. Let Nick know, he'll get them to you or show you where they are. So how do you pick a high probability trade, gentlemen and ladies? Now, how do you pick something that's money? Ooh, good. A couple of you guys know this. Yeah, so you pick a high probability trade based on, right? Do I have a case built for this particular type of trade? So what I mean by that is, a case is, when you think of a trade, think about it like this. Every single trade is, good, Andy. Every single trade is a 50-50 shot. There's no such thing as like a money trade. Every trade is a 50-50 shot. It's a coin flip, right? You buy or sell, you win or lose. Stocks go up, they go down. So it's a binary event essentially. So how do you take something that's a 50-50 shot and you turn it into your favor, right? How do you get it over the hump? Because 50-50 is probably not going to do you. You need to be a little bit better, right? Or you want to be a little bit better. So you want to build a case. When you think about a trade, you're like a lawyer. You're building a case. You're looking for pieces of evidence beyond a reasonable doubt that puts this trade in your favor. Right? Like, how do I take something that's just a guess and turn it into something that's amazing? So you want to build a case like you're a lawyer. So when you build a case, the first thing you're always looking for is a price pattern. So if you think about like what was the patterns we learned in the last 2 weeks ago's webinar? What was the patterns we learned 2 weeks ago's webinar? Right, so we've been learning ORBs. We've been learning quick pullback buys, right? And then we've also been focusing a lot on, flags. So in the last few webinars, we've been focusing on these 3 patterns. And by the way, if you're brand new and you don't even know what those 3 patterns are, I'll make sure to kind of get those things to you guys. So first thing you want to do is focus on a price pattern. All right, so now if you got a good price pattern and you know that statistically this works, all of a sudden your 50% kind of coin flip turns to what? Yeah, maybe it goes to 60%. And then you start to overlay different things, right? You overlay the volume. All right, so your volume pattern's in your favor. Maybe you take this thing into 65. And then you add in stochastics. What else would you add in? Moving averages. Good. What do you add in after moving averages? Good, good. Next thing you want to do, right? You want to see if you're trading with the trend. Am I trading with the trend? So like, am I actually like, if a stock is having its trend, am I trading with it? And then the 6th part is the juice worth the squeeze? And what I mean by juice worth the squeeze is how much am I risking for how much? How much am I risking for how much? Don't worry about this stuff. It's like a 2-hour subject right here. It might be a little too advanced for us. How much am I risking for how much I can potentially make? So is the juice worth the squeeze? So what I mean by like juice worth the squeeze, let's think about like, what's a common pattern like we would trade? Give me a common pattern we've been learning in the last, and we'll map this out. Give me a common pattern that we've been learning in the last so many webinars. What's kind of one of our go-tos? Give me a go-to. If I could turn back time, if I could, good. You can do ORBs. Let's think of something more simple. Hey, Ben Pound, where you been? How's your trading been? I feel like I haven't been hearing from you properly lately. Ben, where you been? I need details. Good. Yes, you can go bear flags. Okay, so these are like all, of course, different types of patterns. So let's just pick like a random stock. What's like a random stock that's been like trending? We'll go with like a Tesla or something, okay? Let's go with the Tesla. So if you're brand new, don't worry about like the nitty gritty. You want to think about rules of a trade. So first of all, you want to build out a chart. So if anybody that's brand new, you don't know what the heck this is, I use a program called, TC2000. It's like 40 bucks a month or whatever. This is the best way to get organized. You can have this layout I think they got, they even got a $10 a month version of it. You can have this layout. So let's talk about like some rules of trade, and then we'll apply the risk management to it. All right. Then we'll apply the risk management principles to it. It's like this particular type of trade is like a very, very common trade. And this is what we call like a flag breakout. So it's a multi-day trade that is based on a daily chart. Okay. On a daily chart, so we use technical analysis. Technical analysis is the ability to read charts, to time your entries and exits, and so on and so forth. Right? It's about not the fundamentals and what a company does, but it's about following price and price action. It's like a flag breakout. So this would be like, let's talk about like the rules of a flag breakout, and then we'll kind of dig into like how it's supposed to look. And then we'll apply the risk management to it. All right. So rules of flag breakout. Number one, you're looking for stocks. When you think about like a trade, like every trade, there's rules to it. When you think about a trade, it should look like a recipe in a cookbook, meaning you have like a very, very specific group of ingredients, and then you got to put them in the right order. And then when you have that, you have yourself a nice dish. And if you mess up a couple of those ingredients or a couple of those orders, guess what happens? Your dish tastes like crap, all right? All of a sudden, it tastes like your mother-in-law's meatloaf, which she may have poisoned. So rules of a flag breakout. You're looking for a stock up over 20%. You look for stocks up over 20%. Looking for stocks that are up 20% in the last 30 days. So that's a very, very simple scan. We were talking about scanning on the last webinar. We're looking for stocks that are up 30% or more in the last couple of days. So what you want to really be doing, you can just run an easy scan. So an easy scan is like you're just building out conditions, right? You're building out conditions of like what you're essentially looking to do. So like a condition would be, okay, I'm going to have XYZ happen and XYZ happen. And when you can do that, like it's very, very simple. So you're looking for a specific criteria, and then you're looking for all the stocks that show up. So you're looking for stocks that are up over 20% in the last 30 days. All right. You need stocks that have a minimum 500,000 shares a day in volume, minimum. 500,000 shares a day in volume. What else would you need? What else would you need? Peter Fellini, you can do that, but we'll talk about that a little bit more in detail when we're done. What else would you need? Okay, you need 3 to 10 days of consolidation in a tight range. All right, you can justify the range as like less than, say, 10%. Don't worry, this is going to be over some of your heads, but I'm just giving you a recipe, then we'll go over some looks. And then you'll be able to kind of marry them together, all right? So you need minimum 3 to 10 days sideways consolidation. What I mean by sideways consolidation is you have like stocks like say that they're just going up, and then they just go sideways for a period of time. They just go sideways for a period of time. They're not necessarily going up or down. They're just going sideways. And in general, in trading, if you have a stock that's got a lot of momentum, meaning it's been trending higher, if it can go sideways for a period of time, 3 to 10 days, what it actually allows you to do is it allows you to build up power in that stock. It builds up more explosion, and then it's ready to go again. The fact that it's actually not going down is a bullish sign that's telling you like there's very few people left to sell this bad boy, and that there's higher prices in the work. So that's like kind of the recipe of what you'd want to be looking for. So like how you would, build that out is you'd hit an easy scan, you do a condition, and then it's just very, very simple. So you can choose a condition. So you're looking for like say price and you can go like price percent change. See right here, price percent change 1 month. So you go price percent change 1 month, and then you put 20. Okay. So now what you want to do is just hit OK. And now you're going to be, now you got a condition. Okay. So now what we wanted to be doing is like adding more conditions. And by the way, like this is easy. You can make any kind of scan you want. When you think about like stocks you're looking for, people always say like, am I able to find X, Y, Z? Right? They're sending people off to Mars and stuff now. Like that means that means you can build any kind of criteria you want into your platform to find the stocks that you want. So we have, the ability to do anything. So now you got price percent change, 1 month, good. Now what else do you want? We want to add more conditions, right? So we got price percent change, 20%. Now we want to add in, okay, let's just say, right, volume. So I want minimum volume on a daily basis at 500,000. Okay. Now what that's going to do, now you want to hit the apply button, and now you're ready to go. So what you can see here is like you have in the stock market currently, you have over 300 stocks that are up minimum. You have about 256 stocks that are a minimum 20% in the last XYZ days. So now like what I'm doing from there, now you can see like some of these are penny stocks, some of these are not penny stocks. So you want to like you can always define a little bit better what you're looking for. So you got price percent change, you got volume. So say I want penny stocks or I don't personally trade penny stocks. Penny stocks that's the marketing mechanism to get people that have never traded before into the market to lose, right? It's a marketing mechanism. We used to trade them back in the day, and it's a big pain to ask because you can make money doing penny stocks, but it's like usually like the guru or a couple of handful of his lackeys, they make all the money. The average lay person, like when stocks are moving around like that much, I would say the win ratio of successful traders that trade like really, really small stocks, the failure rate is probably, from what I've seen, and this is just going from, the last 12 years and teaching tens of thousands of people, I'd say the failure rate is about 99 to 99.5%. Like it's hard. There's only a handful of people that can do it right. Everybody wants to trade penny stocks. Why? It's a man thing. Meaning, if I had, say, 1 share of Amazon, all right? Say I had 1 share of Amazon, and it went from, and Amazon's at whatever, it's at $3,000. I got 1 share, and it goes from $3,000 to $4,000 in 2 weeks. What did you make? You made $1,000. Now you take the same, handful of $1,000, but you buy 3,000 shares of a $1 stock, and it's farting around, and it goes from $1 to, $1 to $1.30. What did you make? It's the same shit, right? But you feel more manly because you had a lot of shares. A lot of times you think if you had a lot of shares, you're going to make a whole crap load of money. That's not necessarily the case. At least I haven't seen anecdotal evidence of that ever. So now we got price over 20, volume. I took out the penny stocks. Now we good to go. So like now if you're on T-Styles, you want to just kind of connect these. And now what you're essentially doing is looking for stocks that are showing that type of pattern, 3 to 10 days of consolidation, so on and so forth. So like your typical kind of flag pattern that would, you would be looking for is something that literally looks like a flag. So you got a stock that's popped up. Now it's gone sideways for a period of days, 3 to 10 days. And then when it comes out of that range, essentially what you're going to do is you're going to buy it as soon as it comes out of that range. You're going to put a stop at your 9-day moving average. Your 9-day moving average on your daily chart. Okay. So there's different moving averages you're going to put. I want you to put a 9, a 20, a 50, a 200. I sent you a layout of all this. It's very, very important. You know, if you're going to trade momentum stocks, these are the best moving averages and indicators to use. Not because like one is better than other. This is just the best for momentum. You know, there's a lot of different ways to trade, but if you're looking for hot heat, then that is the way to trade. So you get 3 to 10 days consolidation. When it breaks a range, you're going to take the trade with the stop loss on. Okay, so it's a very, very kind of simple pattern. You can do it on, you know, pennies and not pennies. It doesn't, you know, you can do it on any type of trade. Same type of deal. So you're looking for a stock that's up minimum over 20% in 30 days. Then what's going to happen is you're going to have 3 to 10 days of sideways consolidation. You got 1, 2, 3, 4, 5, 6, 7 days. What you always want in this type of trade, you want that 9-day moving average. So that's your baby blue line. I guess, yeah, it's kind of baby blue. You want that baby blue line curling up into the trade. What that's going to do is take the risk out of the trade because now you have clearly defined levels. You have, right? It's going to look literally like a flagpole. You've got your 9-day moving average coming up under it. So when it breaks, you're going to buy. When it breaks over the range, you put a stop loss at your 9-day moving average. So what that means is like you're going to have essentially a very, very small risk. This is the whole part of risk management. How can I have a very small risk on a particular trade? Well, I have the ability to take chunks. Does that make sense? Good. And that's the whole ball game of all types of trades. Whether you long-term trade, not a long-term, short-term, long-term, everything is always goes by like that type of action. You're looking for 3 to 10 days, sideways consolidation. And you can do it on large cap, small cap, it does not matter. The pattern itself is very, very powerful. It's like what you're looking for, once again, say you run that scan on TC2000. You got a stock that's like $250, goes all the way to 300. Now what you're going to have is 1, 2, 3, 4, 5, 6, 7, 8, 9 days. You want that 9 EMA curling up under the kitchen? Yeah, we also have swing chat too. If you buy at 300, you put your stop loss right up under that 9 EMA. You're going to risk like $2, $3 on this thing, and now you're off to the races. The reason the pattern works is that the resting phase in stocks, the resting phase in trends allows a stock to build up steam. It allows it to build up power. So when it rests and you get that moving average just like curling up under it, it creates explosion. And what you're having is a squeeze between levels of supply and demand. And that's when you could get a stock that just goes bajonkers. And we do that trade whether we're intraday trading or intraday trading, long-term trading, does not matter. Like you're all, that's a trade we do all the time. So a similar deal. Like if you see here, like this is a trade we were in a couple days ago. You see, got like a nice trend. This thing's at $55, runs up to $80. What do you start to see here? 3 to 10 day sideways consolidation. You got your 9-day moving average curling up under the kitchen, right into that breakout, right? You want multiple kind of tests of the trend line. When it starts to go, they'll start to go. And of course, there's always a little bit more nuanced to everything, but that's, the general look of, a particular pattern. So now, like, how do we run the risk on this? That's always the question. How do you run the risk on this? Like, how do you manage your risk? Like all these different things that we're talking about. So rules of the flag breakout, once you have those, all right, need 9 EMA, curling under the stop. Need 9 EMA curling under the stop. Break of the 3 to 10 day consolidation. Just you're going to build a range in that 3 to 10 days. You want to break out. You're going to buy the break of the 3 to 10 day consolidation. You're going to put your stop loss under the 9 EMA. Yes, Miss Catherine, Miss Strobel, you are correct on that. Once it comes out of that pattern, then it is a breakout. So once you break the top of that range, that's a confirmed breakout. That's a great question, by the way. Or actually, just more of a statement. You had it down. Break of the consolidation, stop loss, which is your order that you're putting into your broker that says if the trade goes against you. And then you want to give it a little bit of room. So your stop loss goes under the 9 EMA, but give it like, right, a little bit of extra room, like a half candle's worth of room. So whatever, however much range, like it's been moving around the last few days, kind of take that and cut it in half and just give it a little bit extra move. Good. So those are the rules of the trade. I personally don't wait for the retest because if the stock is hot enough, it may not retest for a long time, Drew Shield. So now let's talk about like, okay, how do you determine, how do you determine anything else on this trade? All right. So there's different things that you always have to do in a trade. Number one, what are some different things that you have to determine on any given trade? Number one is, of course, reward to risk ratios. So we're going to take the same trade, right? We're going to always determine reward to risk ratio. So what is reward to risk ratio? Reward to risk is how much you will gain if the stock moves in the way you want versus how much you will lose if it goes against you. It's your potential gain versus your potential loss. Why is that important? Well, for example, if you enter a stock at 10 and anticipate that it could go to 10.30, your potential gain is 30 cents. If your stop loss is at 9.90, you're risking 10 cents. So your reward to risk ratio is 3 to 1. You got 30 cents risk to 10 cents reward. Why is that important? Well, the reason is this. Say you got 1,000 trades in a year that you're going to take. Most people, this is where they screw up. Say you got your 9 EMA could be 3%, 4%, 5%. I mean, it could be a little bit, you want it curling up, but it could be a little bit depending on what your reward is and how much the range of the stock is. Honey. So reward to risk. Say you take 1,000 trades in a year. Right? You got 500 wins. Your average win is $200 per trade. You got 500 losses. A lot of people think 50% win ratio is bad. You get 500 losses. Your average loss is $100 per trade. How much do you make there? That's 100K in gains, 50K in losses. So your net $50,000. Even at a 50% win ratio, if you are getting in proper patterns where the range is tight and your risk is minimized, you can still make money. Right? This is going to be very, very important because I've met traders, I'm not even joking, that have like 70, 75% win ratios and they still lose money. Does anyone know how that can be possible? How can you have a 75% win ratio and still lose money? Anybody know? Well, think about it. If you have, say you have 750 wins, but like you get really excited, like every time you have like a gain, you take $50. Well, guess what? What's 750 times 5? What's 750 times 50? What's 750 times 50? Not much. So you can have the best win ratio in the world, but what are you going to make? I think this is, what is it, 27,000, 37,000 in gains? And then, so you're going to have $250. This used to happen to me when I was new all the time. Like, I win all the time and I get smoked out by one damn trade. And I would get smoked out by one trade and it would be like a heartbreaker. Because like you're in this, anybody ever been in life just been in a spin cycle where it's like you're making progress and you're feeling pretty good, and then you're like making progress and you're feeling pretty good, and then and I was like that. Like I was winning all the time, and then like I would have my losses would be like, like maybe I lose $200 on a trip because I'm stubborn. I'm a stubborn bastard. That's my mother. And I'm a stubborn bastard. So it's kind of like, man, I'd lose on the trade, but I would lose like more than I would win. So like now, like, okay, I'm winning all the time, but what is that, 50,000 in losses? It's like you're net, like you have this high win percentage, but you still lose. You still lose. And this is a natural psychological thing that pretty much like almost all humans go through, or all traders go through, which is when we see green, when we see some money on the table, what do we want to do? We take it because we've been indoctrinated. We've been told, right? You can't go broke taking profits. And it makes us feel good when we have some profits, we take it. Or you've been losing in the past, so you see some money and you want to take it. But it doesn't really cover your losses. And once that happens, like you're in a very, very weird cycle. So you gotta have, right? If you pick the right patterns, you don't have to worry about that. You pick a good pattern, you don't have to worry about that. Because if you're using your 9 EMA, you're using really tight patterns, and you don't want to use the 9 EMA for all patterns. It's that specific pattern. I should clarify. Every pattern has its own spot. Then you're gonna be good to go. Does that make sense? Good. So let's talk about position sizing. Let's talk about position sizing. How do you size these positions? How do you size it? So there's two types of position sizing that somebody would do in trade. All right, two types of position sizing that somebody would do in trade. So like let's go back to this Tesla trade real quick. And I'm just making up shit because this was like the one that was on my. This was something I was already looking at. All right. So let's talk about this. Like, how do you size? How do you know? What do you want to do? Okay, so like say you have a flag breakout on this Tesla and you buy this at, when it breaks the range, it's at like $110 and $112. And your 9 EMA is at like a little bit under 1,000. So you got like $20, 20 to 30, and you want to give it some room, right? So it looks like it's like about 20 points away, but you always want to give it some room. So like, let's say we use a 30-point stop loss. All right, so say you buy, you're buying this at 110, and we'll just, for math's sakes, right, 30-point stop loss. So we're gonna buy 1,010, stop loss at 9980. Okay, so it's 30 points. You got your curls for the girls under. So that's your risk on the trade. Risk on the trade. So number one, you got your paddle. All right, check. Now you want to figure out is it worth it? Is the juice worth the squeeze? So you got 30 points risk on the trade. So that's a what, 3% give or take? That's acceptable for a multi-day hold. If it's a day trade, 3% is probably too loose. But if it's a multiple day trade, that's very, very acceptable. Usually kind of 3 to 6%, 7%. I've never really risked more than 10% on a trade if it's a multi-day trade, even in investment. So I got 30-point risk on the trade. Now, this is the hard part, right? Like, how do you figure out how much you can make? So what's the reward, right? Where's the juice? Where's the juice? How do I calculate the juice? So how you want to calculate always the juice? You want to think about anytime the last few times like a stock has come out of a pattern, what you want to figure out is how much it made a move. We call that like a measured move. So you can see here, like you had a consolidation pattern over here at like 835, right? And it ran up to 139. So what is that, like maybe 200 points? So we had one time where it went 200 points. You want to look at the last few. All right. The time before when it bounced, right? You had X amount of points. So you want to be looking for like similar scenarios. Like you see here, you got flag pattern here, right? You got X amount of points. So you want to be kind of looking and seeing like, okay, how much in similar patterns has this stock moved up in the past? So that you can get a gauge of whether this stock is worth your time. Like, you know, okay, I may have to risk 30, 40 points or 30, $40. So I need evidence that I can make that times a couple, so 80 points or 100 points, for it to be worth my risk that I'm taking. And by the way, do not worry about price. Once again, like if you had 5 shares of this, or 3 shares of this, or 2 shares of this, right, and it moves 200 points, still a good trade. It doesn't matter that you only had 1 share. If it moved $200, you make $200. Sure beats working. You don't ever worry about the price of stock. It matters more about range. Woo! There's some gas in that burner. All right. So like anytime you do that, always be mindful. Like, so anytime you see like a flag pattern, like say you're like looking at this one over here, and you see this flag pattern, you say like, okay, I'm gonna be buying this at 76. My stop is at 73. What you want to be doing is seeing like, okay, what were the last few times that it moved? So go from top to bottom. So it's like, okay, this one was 20 points. This one was, 20 points, so on and so forth. That's going to give you a range of how much it can go when it gets out of its pattern. That's going to give you a clear idea if the juice is worth the squeeze. So you want to see how much it moved in the past, and then you'll have an idea of what it could move. So now we've got that part of it. So we know the reward to risk. Now we want to think about sizing. How do we size these positions? How do we size these positions? So how do you want to size a position? There's 2 types of, one is the risk adjusted, which is what we're going to do, and then you have fixed sizing. Most traders in the beginning, not professionals, but in the beginning, most new traders, nothing wrong with it because you got to start somewhere. They either use a flat share amount, like I buy 1,000 shares of everything, or they have a flat dollar amount. I buy $10,000 of everything. This is convenient, but the wrong way, because when you see a low risk probability trade, you won't be properly sized in for the big move. Because when you take your layup trade, like sometimes you just take a trade and you just kind of throw shit on the wall, versus like you have a trade you planned out, you thought about, you've been letting it marinate, you did your homework, you're gonna have the same number of shares in both of them. So what'll happen is, if you got your well thought out trade where everything is going in your favor, versus like you take a yellow trade, you got the same number of shares, and your results will always be 50-50. You'll have some good weeks, then some bad weeks, good weeks, bad weeks. You could be in that trader purgatory for life. I mean, I've seen people that just really like trading, but they can't get it going. I've seen people trade for 10, 15 years that can't get it going because they just don't want to make the changes. Risk adjusted sizing. That's going to be very, very important. So when you think about it like risk adjusted sizing, think about it like this. All right. Every trader should pick, every one of you guys should pick how much you want to risk on a particular trade. How much do you want to risk on a particular trade? So like, for example, say you have a $50,000 account, all right? Maybe you want to risk like $500 per trade. So that would be 1%, all right? That doesn't mean you put $500 into the trade. What it means is if you lose on the trade, you will lose $500. So you could have $50,000, $80,000, $90,000 into it. It's if your stop loss is hit, you will lose $500 on the trade. So what does that actually mean? Good question. Okay. So 1% is if you get stopped out. Why that's helpful is if you have 3-4 positions going, you have 1% risk on all of them. You have shit hits the fan and you lose on all of them. All right, you lost 4% of your account, 5% of your account. That's not going to ruin your life. That's not something you can't come back from. You can come back from that in a week. You lose 30%, 40%, 50% of your account because you sized wrong or didn't do it right. That takes months to maybe years. Months to maybe years. Guys, replay, maybe a couple weeks. I get those up late, but I'll try. $500 per trade. So now what do we want to do? Okay, so think about it like this. If I want to risk $500 per trade, I got a 1% risk. So how you want to do a risk-adjusted sizing is, say you've got a $1 stop loss. You got a $50 stock. Let's say we have a $50 stock. And then we have a $1 stop loss. Okay? How many shares can I have? How many shares can I have? Remember, because I want my max risk to be 500. So a $1 stop loss, how many shares can I have? This is just the basic math. Come on, baby. Good, Mikey. Good, Ryan. Good, Timmy. How many shares can I have? I got a $1 stop loss, and I want to risk $500 on the trade. You just divide one by the other, right? So you can have 500 shares. So if you had a $50 stop, your stop loss would have $49. You're gonna have 500 shares because your risk is $1. You have 500 shares. Good, Andrew. Not so good, Mr. Patrick. How you doing? Mr. B, how you doing, sir? Where's JT at? You guys been going into the base? Hey, man, I have no comment. I wasn't going to say anything. We're boys. Good. So now let's think about it like this. What if I had a 50-cent stop loss? So now my stop loss is at 49.50 because I just got like a much hotter entry. Then how many shares can you have? Come on. We just go from $1 to 50, so common sense would tell you, kid. Ooh, good, Philip. This is a good lesson. So if my stop loss is 50 cents, my risk is still going to be $500. The risk is always going to be $500. Good. So now you can have 1,000 shares because you cut your risk in half. So right now you're going to have 1,000 shares. So see, no matter what though, your risk is static at $500. This is how you stay in the game long term. Most people, they buy and then they hold, and then if they make some money, they take the profit. But if it goes against them, what do they say? Well, I'll sell when I get my money back, right? You need to have a static risk management system like this because it allows you to stay in the game. You can come back from this. You can come back from this. When you have a static risk like this, what it's saying is, like, if you lose, you already know how much you have at risk at any given time. If I have 3 positions like this, then I know I have maximum $1,500 risk. I got 3 positions at $500 risk per trade. Now this is just, I'm just making up a number. If you had 20,000, right, then you can go $200 risk per trade. And you're going to be doing the same thing, right? You have $50 stop, and you got a $1 stop loss, goes to 49. How many shares do you have? 200 bucks, 200 shares, which would equal $10,000 into it. Does that make sense? So it's going to tell you, so you can see here, you're still going to have 10,000 bucks into this trade. So you're going to have, you're going to have a lot of cash in the trade in relation to your account, but you still only have $200 risk per trade. A lot of times people think, okay, it's if I have X amount of dollars in a trade, that's my risk. No, your risk is from where you buy to where your stop loss is. And if you can do that right, then now you are in the big game. Comprende? Good. Let's talk about some tips on just managing. So let's just make you a little cheat sheet, all right? Let's say we got $200 risk per trade. So if my stop loss is $1 away, I can have 200 shares, right? If it's 50 cents away, how many shares can I have? 400 shares. If it's 20 cents away, how many shares can you have? 1,000 shares. If it's 10 cents away, you can have 2,000 shares. And then you do the same thing. If it's $2 away, you can have 100 shares. So on and so forth. So like anytime you're trading, just put a little cheat sheet up. And this doesn't have to be $200 risk, right? I'm talking about this is just, right, if I was sizing it for X amount. So you can do, come up with a little cheat sheet for yourself. What do I want to risk per trade? Is it 100? Is it 50? If you're brand new to trading, you may go in really small and say, I'm going to risk $50 per trade, get my feet wet, learn the strategy, get some consistency, get some momentum, and then I'm going to move on from it. When you do that over and over, now you good. These slides are mine, Kim. These slides are mine. No, I just never gave them out before. Tips on managing winning positions to maximize profits. When faced with profit, I always try to sell a little bit of it. Put a stop at my buy price or mitigate my risk. So what that means is, like, say I'm in a stock at 20 and my stop loss is at 19. If I get that thing to 22, 23, I'm probably going to sell half. And then I'll put my stop at my buy price and I'll see how much higher I can go. If I'm up on a position and I can't sell, I usually put a stop at the buy price to mitigate the risk. When the market, so I usually scale out, like say I have 2,000 shares of something, I scale out. When I sell, I usually do 1,000, and then I'll sell 500, and then 500. And that's if I'm, like a stock is trending. If it's not trending, I'll just go half and half. It's important to scale out of these trades for a very, very specific reason. You may have, like, say you buy the stock at 76 and it gets to 80. And you're like, man, it's like I got, say you got 200 shares, it gets to 80. And you're like, fuck, that's a good trade, right? I made 800 bucks. But then, right, like the next day, like maybe it goes higher. And then it goes higher. Maybe it keeps going for a little bit. So like, you may sell it at 80 and think, wow, I made $800. But like, what if it goes to 116? So what I'd like to do is, like, say, into this first spike, maybe if I have 200 shares, I'll sell 100 of it, and then I'll keep 100 for, right, like a little bit bigger of a trade. Does that make sense? And usually once the stock gets overbought on the stochastics or pierces the upper Bollinger Band, that's usually where I like to sell. So on your charts, I sent you guys a layout to this. On your charts, put a Bollinger Band and a stochastics. Anytime a stochastics is over 80, I know most of you guys won't know what it is, but stochastics is just a measure of overbought, oversold. So when you get like a reading over 80, it's considered overbought. Once you get into the 90s, it's considered like an extreme level. And once you have an extreme level, then it's usually a good time to like kind of piece out of it. So once you get into like the 90s or close to 100, like it's telling you you're at a very extreme level. Like, so it's a good time to usually just kind of get out of this thing because they'll come back. You know, and they may keep going higher, but like you've got your trade. You can always re-enter and, you know, do other stuff. Good. Remember to scale out and then trail up those stop losses. Now, let's talk a little bit about just, and I'll break this up into questions. So I know a lot of you guys are coming into our 60-day class. We start this, I believe, August 9th. Oh, it is August 9th. Good. August 9th, we start a 60-day boot camp. A lot of you guys are already registered for that. It's awesome. If you guys need my charts, my scans, my layouts or anything, just put in your email address or phone number. I will make sure to get those to you tonight. I'll have Omar send those to you guys if you don't have them already. You know, one thing that we like to do during class, and you don't have to, but like we'll have you just set up your charts and your scans exactly like mine. So, you know, I got scans for, you know, different things and finding different stuff. So what do we do is just in the beginning, like I just give you all my stuff. With TC2000, like when you turn it on, it'll just look like mine. That way you don't have to like mess around too much with like, do I got my colors right? Do I got my moving averages right? When we start class, we will go over every single point on a chart. We will go through every single point on a chart, like what the heck all this is, and I'll walk you guys through it all. In the beginning of 60-day class, the first 4 classes are just about setting the foundation. So it's for people, whether you're a good trader, bad trader, never looked at stock, it doesn't really matter. The first 4 classes, so about 8 hours, we will just be spending on getting the foundation right. What is the software? What is a chart? What is an indicator? You know, like the basic stuff. Even if you've been trading for a while, you're going to need it. Because if your foundation is weak, you're weak. It always works like that. So 28 live classes via webinar, just like this. We come in 8 p.m. Eastern time. Tuesday, Wednesday, Thursday, then we do 2 classes on Sunday. All right. Classes are all recorded and archived for playback. So like if you've got, you know, look, all you guys are going to have, well, most of you guys are going to have jobs and, you know, stuff like that. So everything is recorded. It's all archived for you. You don't got to worry like, you know, your kids got a science experiment class or, I mean, no, I don't got any kids, but your kids got something going on, then, you know, it's all there for you. So we have it all laid out on the website where you'll be able to go in. So, you know, all the classes are right there. So like this last boot, we're still finishing up this last boot camp. And so you can see like every single class will be all in there. And by the way, we teach long-term trading and short-term trading, like all of it. You know, so we got quizzes, homework, you know, we have a tax guy come in and do stuff, guest webinars, you know, all that fun stuff. And then we got documents for everything, all the journals and everything that you need. It's all in here. And then you can even watch, you know, past, you know, all the past ones. So you can watch all the past ones, you know, you'll see over time, like, you know, my styles, the trading setups are always the same, but, you know, like markets shift. So we, you know, do different stuff like that. Miss Strobel, actually, I've had hundreds of people stay at my house. We do in-person training, but the only rule is you got to stay at my house. We don't, I'm Indian. If my mom found out I put people in hotels, I'd be a dead man. So we do stuff over here, but it's all in the house. And obviously with the COVID stuff, I'll be just rolling around solo for a little bit. Yeah, but I love having people at the house. It just makes it easier because we can go 24/7. And I live on the beach. It's awesome. You know, we hang out here, we go to the beach, we screw around, drink some beers, come back, do some work. Good, good, good. Let's everything's recorded for archive. Q&A, quizzes, homework, every class. We do trade recaps. Trade recaps. When class is done, I put you guys on a trading simulator. So you guys, we have like a layout for a trading simulator on TC 2000. You can use any one you want, but it's nice. I just made this one. So you guys come in and you can, you can kind of mess around with this and make it your own, of course. And we can go in and like, I can watch your stuff. So I can watch your stuff. So it's actually really cool. Like you'll see, we track a lot of our, I can see like what all my guys are doing. I can see what all my guys are doing, which is pretty cool. And I'll be able to see like, okay, this guy's doing pretty good. This guy's got to do a little bit of work, so on and so forth. I can come in and just say like, okay, like what's Big Steve doing? I can come in and say like, okay, Monday, these are his trades. And I can go in and like click them. And then I can see like, okay, and he's trading live. I can see like, okay, he had a good entry, and then notice like he just kind of sold all these right away. So like, and then I can leave comment. So I leave a comment, he can answer back, and so on and so forth. So we can go back and forth and kind of go over this trade and really figure out, he's trading live money. But we can, we do this with once you're on the simulator, and then even when you're live, I'll be able to see these things. So I can go in and click the trade and be like, all right, like, he had, so like, see this one, like I can tell right off the bat, he oversized it, and I can see what he's doing. I can make comments on these things, and then he'll get an alert and so on and so forth. And we got, a lot of these guys, I mean, some of these guys are gonna be doing pretty damn good. I got a couple studs under the belt right now, and Mark's on vacation, but he's been doing a little crushy, 10 Gs, 5 Gs, 16s. And he's been working with me for like a year, so this is not like, but some of these guys are pretty damn good. And the software, the different things that we kind of put into place allows it to, allows us to see and check on each other. And that's a real big, if you're not journaling your trades, like you'll make, Avery, put in your number. I'll give you a call on that myself. I'd want to talk to you about that because it is a lot of work. And like you may have noticed, like I'm a little bit high strung. You got to be ready to tolerate me for like a certain period of time because it's a 6-month program, that one, and it's like I'm up on your. It's an everyday thing. It's not like a once a week thing. So yeah, a lot of the guys I work with, like one-on-one and stuff too, and like it's a pain in the butt. Like I'm looking through their stuff every day, and a lot of times like they're unpleasant conversations. A lot of times they don't work out so well. They'll work out well over time, but sometimes you got to tell people what's up. We work on business plans during class. You wouldn't. Look, you want to start a restaurant, you want to start a art studio, you want to start a bug zapping. What was that business that John Candy had in arachnophobia? That was a good business, right? He had the bug, he was zapping those spiders. He was cash. So you want to do any of those kind of businesses without a business plan, would you? Like you want to go to a bank, ask for a loan, you'd have a business plan. Well, you're trading, you are the CEO of your own small business. You're trying to get it to a bigger business. So you got to work on these trade plans. We have to build out a business plan. What are you going to do? You're going to learn all types of trading with me, but what are you really going to do? Are you going to day trade? Are you going to swing trade? Are you going to do both? How much capital are you going to trade with? How much capital are you going to trade with? Okay, so that's how much capital you're going to trade with. Now what? What are your risk management principles? We have a student community. I got a course book that comes with it. Everything that's in my head is in this course book. You can put this by the John, put this in your car, and when you're going for it, read it. It's just an addendum to class anyways. And then I think really the fun part about class is that, we teach both swing trading, which is longer term trading, and day trading. And I trade in front of my guys every day. So what we do, I'll come on at 9 a.m. in the morning. I put a link in, go to webinar. You can watch me trade. So I'm on screen share and I'm hooting and hollering, showing what I'm buying and selling. But I have, my charts up and everything. So like you're going to be able to kind of get like a firsthand view of like what the heck it is that we do during the day. I think it's very important, for any function of class for somebody to go in and trade in front of you for a specific reason. If you read any book, you have a trading book, you watch some online class, which hopefully you're not doing all your education from online classes, or at least if they're recorded. You do all this, the examples, the things that they show, they're going to be cherry picked. So like if you do like buy somebody's online DVD, right? It's like $200, $300. The examples are going to be cherry picked. They're going to take literally the best ones out of the last like 10 years and put them in there. So you're going to sit there and they'll be like, oh, look at this, is so simple. You draw a little line here and you make 30%. Right? And you're like, oh shit, that's so easy. The live trading is good because like we make a lot of trades every day. So you start to see that nuance of like, what do they look like if you got to tilt the air a little bit? What do they look like when you're not cherry picking every single damn example, right? You ever watch some YouTube video? When a guy makes a YouTube video, he's taking probably the only, especially you got a lot of these kids right now making these classes. When a guy makes a YouTube video, he's only taking the best trade he's probably had all week. Right? What about all the other clunkers? So that's when you get a little bit tricky. So I love trading in front of my guys. It gives me a level of accountability, but it's going to help you guys because you're going to see how trading is with the gloves off when things are going good or bad. Like there's days where this doesn't happen often, but there's days I can't get it together. And that's where we really want to go with this. Our boot camp comes with additions, so you get access to chat rooms, day trader, swing trader, all right? Day trader, swing trader, you get access to the chat room. So we use Discord, it's mobile friendly, long-term trading and short-term trading. You get 6 months of access to that while you're going through class. So you're gonna go through class, and then when you're done, you have still the community of being able to watch me trade, and you can also, right, giving out what I'm trading. And same thing, my mentor, Paul, teaches the part-time trader class. If you're a part-time trader, he's showing exactly what he's buying and selling. He's going to put stop losses and so on and so forth into all these things. So you can see what he's doing. We have guest webinars. So we'll have guest webinars, tax guys, trade journaling guys, former students, all that kind of fun stuff that's an addendum. We start June 9th. If anybody just wants to chat about this stuff, you let me know. I'll have myself or Omar. He's my childhood best friend. His birthday is also coming up. It might be August 6th or August 9th. So you let him know happy birthday. Give him, that's his number, but put in your phone number. I'll call you or Omar will call you. We'll chat about your goals. Even if you're like kind of like, fuck, I don't know if I can make this thing happen. If you want to chat about it, do it. We do have payment plans and kind of all that fun stuff too. So if you're thinking like, fuck, like this is a lot of money up front, we do split it up and, we can do stuff like that. The big thing is if you want to learn this, I'll figure a way to get you in class. The big thing is just put your hard hat on. And like I said, like I am, it's an intensive class. You're going to find a lot of stuff. You want to learn how to trade and like, you want to learn it quickly, like 2 days, 3 days, doesn't exist. It doesn't exist. If you do, whether you're with me or not, don't do any DVD type stuff where it's like on demand. This is no different than being a doctor, a lawyer, janitor, teacher, accountant, whatever. It's a job. You wouldn't go into your job. You wouldn't go into your job and try to learn a high pressure job from watching some online tutorials. You can figure it out. Don't get me wrong. You can figure out. It's a matter of time. That could take you 2 years. It could take you 6 months. Nobody really knows. But like if I came into your job and just try to figure out 2 days, it'd be tough. That's why the class is so long. I wish I could teach it to you faster. I really do. But by the end of this, I don't have any other classes. So there's no upsell, downsell, like there's nothing else. What I have in my brain goes in this class and then it's done. And that's the beauty of it. You're gonna learn all different types of trading. Every kind of trading you can imagine. That's what we do. So these are the good things. If you need a little chit chat, put in your phone number, we'll give you a call. Hey man, I got a lot of students. Edinburgh, is that Scotland? Dude, I've been reading a lot of books on Robert the Bruce. I love medieval English history. A nice British longbow is a gentleman's weapon. Man, that's so cool. Doc Brown, look forward to having you. Nakim, I look forward to having you. Mr. Raju, look forward to having you. Hey, Jacob. Shakov. Good. Hey, Steve, Mr. Daddio, I'll get you a deal on that. Stick your email in. I'll have one of my guys hook that up. Avery, look forward to having you. Miss Trouble, Hugh Jackman. I'll make sure to get that to you guys too. Let's open this thing up to some questions. I look forward to having you guys. I will say this, like class is intense, but like it's a show. I bring the heat every day and I expect my guys to do the same thing. We've got an awesome community of people that because it's lifetime access, you can retake my class as many times as you need. You'll have a chance to deal with and work with all the other students. So like, we're all in here, hanging and chit-chatting. So you get also like other people. We get other people. Chicago, Mr. Vaughn, I look forward to having you. Hey, Doc, we can break that up. I mean, there's no point in doing a smaller class because then you'll be unfulfilled. It's like having a makeout without the Big Bang. Sorry, man, I shouldn't be saying stuff like that. Doc, I'll figure a way to get you in class if that's your thing. Yes, you will get to work with the other students in class. You can name me any city you're in. I have multiple students in there. You in Paducah, Kentucky, I know somebody there. And if you're in Paducah, Kansas, I know somebody there. Everywhere we go, I mean, I've been doing this since 2008. So we have experienced students that you can also work with and mingle with. And yeah, we got Raju, my man. Dude, it's like an Indian nightclub in our chat room some days. You'll have a lot of fun with it. Oh man, Samuel, I look forward to having you, brother. If I missed your questions, if they came in the beginning, I just didn't answer them. It's because I didn't see them. They came in a little hot and heavy. Feel free to re-ask. I really apologize sometimes. Hey, Mr. Doc Brown. Hey, man, Back to the Future is one of my favorite movies. Just for that, discount. Weather and Destin is. Hold on one second. I gotta refluff my teeth. If I could turn back time, if I could find a way. Good. Hey, Tariq, I've got actually a good student. I got 2 students of mine in Dubai. One's an Englishman that's been living in Dubai for the last 10 years. He works at a hospital and he's using interactive brokers And then I got another one that's actually from Dubai. I'll introduce you to them. They have no problem. You've got to use a international broker that trades in the US like IB, and then we got to get you the right charting platform. You're good to go. Hey, Silvina, look forward to it. Hey, Jamal, his name is Andres Cortez. I'll put you on email with him. He's an awesome dude. All right, all right. Anybody got any questions? Anybody got anything? Mr. Shoes, man, I look forward to having you. Dude, you know Kevin Maradino? You got to be kidding. Guys, by the way, this is my phone number. That's my celly, so don't waste it. If you ever want to chat, like you've got just like, you know, something that's eating at you, I'm the man to talk to sometimes. Hey, Marco, that's a good question. So Marco guy's saying, if you have a screen share during your training, can I just shadow you? Marco, you can use me for idea generation and you'll be able to shadow some of it. But the problem with trading is like this stuff is fast. Like think about this, like if it's my idea and I've planned this out all night and I'm ready to go, man, I'm moving in and out so fast of stuff while you're fumbling around hitting buttons, like I'm already like making moves. And that's what happens when you're reactive. You know, I get on a half an hour before the market opens to kind of go over the trades. But when it's not your trade, like you still are a little bit nervous. Like you don't manage, most people won't manage the risk right. They just won't be able to get a lot of the things right because it's not theirs. So it's still important to find and learn the strategy so you feel comfortable with it. Hey, Silvina, we'll figure something out. You know, I'll let Omar give you a call, and you know, he's pretty good about that stuff. Sumit, we do. Yeah, we got a huddle tonight, baby. We got class, of course, tonight. Sumit, I put it in the day trading, swing trading channels. I'll put it in the bootcamp channel too. Miss Beltran, yes. You can take bootcamp as many times as you want. I'll have Kevin. Let me see if I remember your email address. I'll have Kevin just add you in. Ida La Cruz, something like that. I think I got it. I got you, Miss Beltran. And also, like, you can just go on the Bulls on Wall Street live chat and tell Kevin you want to just come back in the next boot camp, and he will just add you in. Yeah, you can retake class as many times as you want. Buenos Aires, cool. All right. Anybody else? Going once. Going twice. So, adios, muchachos. Peace in the Middle East. That's the 1980s terror when times were good.